A special guest today, Thomas Hayes, is the chairman of the Great Hills Capital. Thomas, welcome to Bloomberg HD.
Thanks for having me, Ali.
First question is inflation rose at 4% annual rate in May, the lowest in 2 years. How do you read the recent inflation data? Does it mean that no recession risk for upcoming months?
Yeah, this is definitely positive news. Obviously, inflation has been coming down from 9.1% last year to 4% this month, better than expectations of 4.1. On a month-on-month basis, it was better than expectations. It came in at 0.1% versus 0.2% estimates. And core came in line with expectations. So all of this points to a very positive situation where we could have a soft landing moving forward versus a hard landing. And we may, in fact, be able to avoid a recession if the Fed uses this opportunity to get out of the way and stop with the aggressive tightening. So we're pretty optimistic that they may be able to navigate a perfect soft landing here.
And Fed meeting, Fed Reserve is expected to pause his year-long campaign of jacking up interest rates to curb inflation, offering a reprieve to consumer and businesses. So what's your expectation from the Fed meeting?
Yeah, right now, if you look at Fed Fund futures after the inflation data came out, it's showing more than a 98% chance that the Fed will skip hiking this month. And the question is going to be, does the skip then turn into a pause next month, which is the key? You know, there are expectations that maybe they have to go 1 or 2 more hikes. We're in the camp that we believe that the data will come in over the next 4 weeks that will enable them to turn tomorrow's skip into a longer term pause. And probably we could even see some cuts early next year, maybe 1 or 2 if needed. But by and large, rates will be higher for longer, but they're not going to go up anymore. And that's going to change the dynamic of the environment moving forward, both for stocks and for the economy. With the Fed out of the way, this is going to be very, very, very promising. The other thing that we're going to see tomorrow is even if they skip, probably the press conference, they're going to talk very hawkish. So they're going to say, okay, no hikes this month, but we're going to go next month if we have to, unless the data shows us that we can continue to pause. So I think expect some kind of hawkish language coming out of the press conference this week, even though they're going to, in fact, pause.
And Fed Chairman Powell also talked about the banking crisis a little bit. So what do you think about the banking crisis? Are we done with the new banking failure, or it might come in the few months?
Yeah, it seems to be mostly in the rearview mirror, but there's still some wobbly banks that certainly can't take any more hikes. And I think the Fed historically raises rates until they break something, and they certainly did this cycle. They put 4 or 5, pretty large banks into bankruptcy, into receivership. You could say necessarily or unnecessarily. I would take the latter. So I do think that most of the banking crisis, provided the Fed actually pauses and follows through with a pause in coming months, I think that banks can now start to get a comfort around what their funding costs are going to be, number one. And with rates stabilizing, their portfolios will start to improve. The bonds that they hold will start to get bid. That will be good. Their loan book should start to improve a little bit. So all in all, it's up to the Fed. If the Fed stops here, we think that 99.9% of the regional banks are going to be great, and it's going to move forward, and there can be an opportunity there if you look out over the next 12 to 18 months. If the Fed actually hikes again in July, which we think is a very low probability, it could be devastating for the regional banks. So I think he understands that. He referenced it in his last press conference, and he's going to be responsible about that. Maybe take a little hair bit of inflation in the short term if he has to, just to keep the financial system stable, because at least 2 out of those 4 banks that went under were maybe unnecessary.
Okay. And my last question, Thomas, about the stock market outlook. What's your points or highlights on the recent stock market outlook? Best performing ones, bad performing ones, your expectation in upcoming weeks?
Yeah, so I think with the Fed out of the way, it's going to change the dynamic. So we're seeing it today already. The US dollar is weaker. What type of companies is that going to help? So year to date, it's been what we call the Magnificent Seven. Seven very large tech companies have driven a lot of the rally. Now that rally is starting to broaden. Why is that? So with dollar weakness, we're going to start to see some of the multinationals that have been left behind that get 50% or more of their revenue from abroad, they're going to benefit from a weaker dollar. For instance, Intel gets 82% of their revenues abroad. 3M gets almost 50%. PayPal gets 47% of their revenues abroad. A weakening dollar is a very positive thing for earnings. Stanley Black & Decker, et cetera. The other thing you're going to start to see is emerging markets and China, even Turkey. I think equities are going to start to do very well in coming months and coming years as emerging markets gets a bid, as the dollar continues its downtrend. In recent weeks, emerging markets has been hit because the dollar was bid up in anticipation of the debt ceiling negotiation. Now that that's in the rearview mirror, now that the Fed's out of the way, the dollar can resume that downtrend it started in October, which will also be very good for emerging markets and risk assets like biotech. And then finally, interest rate sensitive groups are going to finally start to get bid. Selective REITs will do well as the longer end of the treasury curve gets bid and rates compress. REITs will do well. Even banks, as we talked about, I think are going to start to do well. I think you'll see a bid in regional banks, which will also help small cap stocks, which have been left for dead. And the small cap stock participation is going to really give people a clue that this rally is broadening. So I do think that the opportunity is more under the surface of the indices than the indices themselves. Maybe the indices go up another 5 or 7% for the year, but you could have many stocks that haven't participated so far up 20, 30, 40, 50% before the end of the year. And those are the opportunities we're looking at.
Yeah. Thomas, thank you. Great points. And thank you for your time.